Should you wait to buy in this market or buy now? With interest rates on the rise, you may be wondering, should I wait and just see how it all settles out, or should I buy now? First, let's talk about interest rates and how mortgages are set. Many people think that when the Federal Reserve increases rates, that's affecting mortgage rates, but it's not exactly how it works. Home loan interest rates are actually driven by the mortgage-backed security market. So think of it as one of those things that, like any stock or any investment that's publicly traded, if there's a lot of demand for mortgage-backed securities, then interest rates will fall. And if there isn't a lot of demand for people purchasing mortgage-backed securities, then interest rates going to go up. So here's what has happened over the last couple of years. When the pandemic hit our country in 2020, the Federal Reserve stepped in with the intention of keeping this economy moving forward, and they started to purchase mortgage-backed securities in huge increments. And that directly dropped interest rates. So when we hear in the media that the Federal Reserve is increasing interest rates, they're not increasing mortgage rates. They're increasing the Fed funds interest rate, which is an overnight rate that banks pay. It's not directly home loan 30-year, 15-year fixed rates. But the other action of the Fed has been this whole purchasing mortgage-backed securities. Well, they have stopped the purchasing of mortgage-backed securities and are now starting to sell off some of those mortgage-backed securities. So now the mortgage-backed security market is flooded with a lot of product and there aren't a lot of buyers. So that's one reason why interest rates are going up. So I just think it's important to understand that sometimes the media really confuses us, right? They want to be like, oh my gosh, the Fed's increasing the interest rates again. Now, when the Fed increases the Fed funds rate, it does impact me and you. And here's how. If you have a home equity line of credit on your home now, it's very likely tied to the prime interest rate. And the prime interest rate is directly impacted by the federal funds rate. So when the Fed increases the Fed funds rate, your home equity line of credit interest rate is going to go up. Secondly, credit cards, and this is a really big one. So if you're carrying balances on your credit cards, know every time that you hear in the media, and it's going to continue this year, if the Fed is increasing the Fed funds rate, that probably means the interest rate on your credit card is increasing as well. Now, why is the Fed doing this? They're doing this because inflation is up and they need to control inflation, which means they're going to increase the Fed funds rate, which again directly impacts, in this case, credit cards, let's say, which ultimately means that they want the economy to slow down a little bit and tame inflation. I know there's a whole lot going on here, right? Well, my point is, if we think about, should we wait to buy a house? Interest rates, even with the rise recently, post the pandemic, interest rates are still historically very competitive. So if you want to buy a house and you're in a position to buy a house, then it's a great time to do it. Let's examine the history of home loan interest rates throughout the decades. This is really going to be a good picture for you to kind of see that what we've experienced in our country over the last couple of years with home loan interest rates has been unreal. In fact, it's been historic. So if we just really look back even to the last 10 years, you're going to see on this chart that there have been moments where we have touched and exceeded a 5% interest rate. So the point in time of 2020 and that pandemic that hit, it was historic and it was yesterday. It's not today, and it's very likely not going to be tomorrow. But the bottom line is we all need to have a place to rest our head, to raise our families, to call our own. And if that is time for you to make those life choices, don't let interest rates stop you from doing that. If you can afford it, talk to an experienced mortgage lender that will put together a strategy and help you really see what the numbers look like based on today's interest rates. So let's take a look at another chart I have for you that shows you loan amounts and various interest rates. This is helpful because for every 0.25% of interest rate based on a particular loan amount, you can start to get a sense of really what's happening to your principal and interest payment. Now remember, the principal and interest payment is actually the loan payment for the money that you're borrowing. Your total payment will include things like homeowners insurance, potentially mortgage insurance, property taxes, and not included in your payment, but something that you will still have to be obligated to pay, is potentially a homeowner association fee if you're purchasing a home that has one. And looking at the chart, let's focus on the $500,000 loan amount for now. You're going to see that that payment is changing about $80 per month for every 1/4% that the interest rate goes up or down. So let's think about that. Maybe if the interest rate goes up 0.5% on a $500,000 loan amount, it in effect is changing your payment monthly by about $160. Now that's not chump change, I get it, it's still $160. But many times what I find is people don't really realize when they hear in the media that interest rates have jumped by 0.5%, what that really means in true dollars and cents. So this chart will help you really understand the actual dollars and cents of the payment changes for every 1/4% that the interest rate changes. Let's set interest rates aside and focus on something that I believe is a bigger threat to home ownership in our country, and that is affordability. So what we have seen over the last couple of years is a huge demand for home ownership, whether that is first-time home buyers, whether that's people moving up, moving down, whether that's purchasing second homes or investment properties. There is a big demand for home ownership, which means that home prices, going back to that whole supply and demand type of thing, home prices have increased. So this chart is helpful to see on a nationwide spectrum what that really means. So across the nation, our country has seen a 20% on average increase in prices of homes. 20%, think about that. So if that home last year was $500,000, at 20%, that would make that home this year roughly $600,000. So in my opinion, the threat isn't just the fact that interest rates have gone up. Certainly that's going to impact your payment, which we have shown you earlier in the chart. But the bigger threat is if you wait to buy, where will prices be in a year or 2 years or 3 years from now? We don't see that demand slowing at all. Do I think that the country is going to continue to appreciate at 20% year over year? No, I don't. That is going to slow down. There's no question about it. But even if it slowed to a 10% appreciation rate, 10% of a $500,000 house is $50,000 year over year. So the math is there. Historically, real estate has been a very good investment over the long term. That doesn't mean that there aren't market cycles where home values increase and decrease over time. If we look at it over a long spectrum, investment in real estate makes sense. It has 100 years ago, 10 years ago, today, and it certainly will in the future. So don't forget, if you purchase a house today, even with interest rates where they are currently, you can always refinance to a lower rate if interest rates do go down in the future. But if you wait to buy, and let's say you buy in 2023, 24, 25, or 26, you're paying prices at that point in time, as well as the interest rate in that point in time. So you can't go back to 2021, 20, 19, 18 prices of real estate and buy it. I wish you could, because I would be buying more real estate, but we can't. What we can do is control today and just realize that a refinance with regard to the interest rate is always an option if you can qualify and if interest rates drop. And that's important to know because there's a lot of conversation right now about a potential recession. Well, remember, real estate and home loan rates do very well in recessions. Generally, home loan rates will come down in a recession and the real estate market bodes well. So if a recession is looming in the future, as all of the smart people out there say, then that would mean if you're purchasing today at an interest rate at current market, if interest rates do go down when the recession hits, if one does in fact hit, then you can just refinance out of that interest rate and drop it, which will save you a little bit of money a month. So I'm often asked, hey, Kelly, that real estate market's going to crash. I just know it. What do you think? Well, here's what I think. This time around, it's different. And it's different because the demands are different. So if we really start to look at what's driving the demand today, we have a few factors. One of which is we have millennials in the home buying market, which is not the case in 2008. Secondly, home builders really slowed building new product, and that happened around 2010. So we're way behind on just the amount of houses that need to be built to be able to meet the needs of home buyers out there. And lastly, the home loan part of the equation is very different today than it was back in 2005 to 2008. I've been lending for over 26 years. I've seen a lot of market cycles, and I can tell you back in that time, the lending part of the equation was much easier. Anybody could get a loan. There wasn't full income documentation. There was a lot of stated income. There was all kinds of exotic loans out there. It just wasn't a great type of lending environment that set people up for long-term success. Today, that's different. And if you're going through the home loan process, you're probably shaking your head going, yeah, because my lender keeps asking me for all kinds of stuff. That's because the federal regulations changed because of what happened in 2008. And so today, from a lending perspective, we have to have the ability to document your income and ensure that you can pay that mortgage. So for a lot of reasons, I do not think we're going to see another big housing bubble or crash. That said, I do believe that the market will slow down, and I do believe that appreciation rate will slow. It can't keep up at 20% year over year. But if you're in the market to buy a house, just realize that you're going to be in a fight depending on the area around the country, what's going on in that particular market, and what the appreciation rate is and the demand is for those markets. Now more than ever, it's important to work with an experienced lender. In our case, we use a tool called Mortgage Coach, and we do that because we want to be sure that our clients understand not only the different interest rate options, but we want them to know what their maximum amount that they can qualify for is, and really start to see in a very compartmentalized type of view the differences, and then be able to compare based on what their needs and goals are. Mortgage Coach also will show you what happens over time when you invest in real estate. So the wealth that you're building, it's a great tool just to kind of see what happens in 10 years, 15 years, 20 years, or at the end of 30 years. Okay, I just rambled on for a really long time here, and I know I gave you a lot to think about, but please post your comments. And please subscribe to my channel. I want to continue to bring home loan education so you can make informed buying decisions. Until next time.